Okay, today I'm going to go against one of my rules. I don't like to make videos on something where I am not a subject matter expert. I make videos on reliability and maintenance, on leadership. I make them on my retirement journey. Okay. And my experiences, I'm an expert in my experiences and my analysis. And I could make errors in there, but I do know my journey. Today, long-term care insurance. So why am I talking about this? I am getting overwhelmed with questions on long-term care insurance from you. And I do have an opinion. I have made an analysis. I'm not an expert on it. Please seek out an expert. What I'm going to show today is my interpretation of those experts. I'm not selling anything, and when you're dealing with a salesman, you're not sure if they're trying to make a sale or they're really trying to help you out or a combination of both. So I'm going to talk about what resonates with me, with the information I see, and what decision I'm making. I'm currently 58 and I'm married, both healthy, no issues, but just how I think about that. So anyway, some of the things you've seen, 70% of the people will need some sort of long-term care. The average need is 2 years. These are the marketing things. One marketing thing I heard is you got a 3% chance of your home burning down and you have insurance for that. You got a 70% chance of needing long-term care. You really need long-term care. One of the things I find interesting, I go to Home Depot. My last purchase was a little compressor, and they ask you if you want the insurance for it. Just about anything you're buying now, you can buy insurance. And why? They make a lot of money on these things. That's why they're selling things. There's one of the things that you have to remember whenever you're being sold something, there's somebody on the other side of the transaction that thinks they're getting a good deal. Sometimes that can be an equal good deal. Sometimes it's biased towards the seller. And when I think about insurance companies, I think about the baseball fields, football fields, and the high rises, the skyscrapers that they have offices in. And I'm saying they seem to know what they're doing. So how did I decide? That's the topic of today's video. So as I look at this, I've got three paths I could go on. One, you've got long-term care insurance that's use it or lose it. For example, you can get a policy that has premiums based on your age, based on your health, based on if it's you and your spouse. You get something like if you have the need for this insurance, it would be something like $4,000 a month by 4 years, and it's got some inflation adjuster in there. So that they are all capped. You can't just say it'll just pay for everything. They're meant to offset cost. So that's kind of a use it or lose it, something like that you would see. And your premiums are highly variable based on if you start this at 50, you start this at 60, are you healthy, all these different things. And then there's another one that's really interesting, I think, life insurance with a long-term care rider. It really has this, similar type coverage, and you can get 3,000, 4,000, 5,000, 6,000, whatever a month, all cost money. But if you don't use it, you may get like $100,000 life insurance, so your heirs would get that if you don't use any of it. So typically the one that I was looking at, if you did use it, it started eating away into this $100,000 until that was actually the cap of what they would spend. So you would get so much a month until you consumed the $100,000. Now these are highly customizable. You can make that 200,000, 300,000, 500,000, anything you freaking want. That's what makes long-term care so complicated. Is it's highly customizable, if that's a word. Or you can self-insure. So that's what I'm going to talk just a little bit about, is comparing this option. Actually, I'm just going to use this one just to illustrate a point, to self-insure. So I'm going to compare one of the long-term care insurance options. Like I said, there's infinite here, to self-insurance. And, These were some numbers that I found. You have to do your own research. I'm really trying to communicate how you should be, or how, not how you should, how I analyze this, okay? And there could be holes in it. Please give me comments if I'm thinking about this wrong. Save me from making a mistake, but this is how I thought about it. So, hey, this is a 58-year-old couple. They're healthy. I got a plan with $4,000 a month is what they would pay if you needed long-term care, either in home or at a facility. 5 years, 3% inflation, $125,000 life insurance if you don't use it, okay, for on this when the second person dies. So like I said, highly customizable. You can have these say anything you want. Premium for that was $696 a month. Okay, so that's a lot of money. That's a whole lot of money, and for several folks, that would be one of their major expenses in a month, and may have them not be eligible to retire because of that. That's a big number. So self-insurance, one of the things that you need to do is look at the opportunity cost of something. Yes, you got a 70% chance of needing something over here. It could be, 2 years. That could be in your home. That could be at a nursing facility. A lot of options inside of there. But let's look at that 58-year-old couple with no history on their parents and grandparents of needing long-term care, like with dementia or something like that. You take that, oh gosh, I didn't change that. I was using another one. So let's change this to 696. I did use the right numbers, and I used 22 years over here, getting me to 80 years old. That's 80 years old. Okay, and I just used a 7% return on the money. That equals $438,000. Now, you can have some of that money in a HSA. You can pump in an HSA money if you have a high deductible plan until you're 65. And it takes discipline. You got to save the money and not spend it. So when I'm looking at this, I'm looking at, do I want this coverage over here, or do I want $438,000? And you look at what this would pay out. You're talking 50,000. It's 48, but 50,000 a year times 5 years. So you're talking about $250,000 times 2 people. Okay, so $500,000 of payout. If you don't use it, you get this 125. Or what's behind door number 2 is $438,000. This seems like the solution that fits me. We're both healthy, my wife and I, no history. We've got a lot of discipline in life. We're using HSA. I'd rather have, and there's no guarantee. I don't know what the stock markets are going to return. But this $438,000 is worth more to me than, kind of a worst case if we both used, my wife and I both used a health care for 5 years. You're talking about $500,000 now, plus it's indexed up for inflation, so it will be a higher number than that. It may be $750,000 that it could pay, but I'd rather have this. That's just a decision that I'm looking for my clicker. That's just a decision we've made. I'll continue on another one. So my plan. The first spouse, helps with the second. My wife and I are like, the first person is going to help with the second. Good chance there may be the first person that, needs support, they could stay at home and be assisted by their spouse. Good chance of that. That's why when you buy insurance, actually, if you buy 2 individual policies, it's more expensive than buying a couple together, because they know the one can take care of the other. That's plan A. The plan B is, hey, if the first spouse dies, say that's me, my wife Lisa, she has a home and all of her other expenses that she won't need. If she needs to go into a nursing home, you could take Social Security and take sell your home and all your other food and things you need, cable, internet, all that stuff goes away, and you can sink that money in. So that's kind of plan B is, yeah, you don't need two homes. You don't need a nursing home and your other home. And the other one is a savings drawdown. All my models using, my new retirement software that I like to push and plug, check it out in the link, is, I should have plenty of savings to do that in the future. Now, the risk. Hey, here's the big risk, and this, it drives a lot of fear in people, is the early need of funds. So, I'm 58 right now. If I'm incapacitated at 65 and I need to be in a nursing home for, uh, at 65 for 5 years, my funds, my savings have not built up enough to handle that. So that's the big fear. Remember, my analysis previously said, hey, you keep this money for 22 years, you'll have $470 some odd $1,000. Yeah, that money didn't have enough time to grow. But still, that's a risk I'm willing to take. Bottom line, there's really no right answer for this. I hate to come to that conclusion. There's a right answer for me right now, and I think that's self-insure. Got, this is my game plan here. But the health and history of your family, your personal health and your history is a massive factor in determining this. And, also the affordability, can you afford $700 a month and still be retired? If you have to keep working another 5, 6, 7 years to be able to afford that, is that worth it? So long-term care, they're very creative with solutions for you. If you want to sleep at night and you need a creative solution, I mean, they can put together any kind of package. I don't think it is a poor product. It's an expensive product that I've got other ways of thinking through financing of that. Okay? Hey, give me some questions. If you see some errors in my logic, please let me know about it. I'll correct it, and for myself, and then maybe make another video on it. This is Joe out.